Hey everyone, and welcome back to the Noob Selling Options channel. Man, am I absolutely thrilled to have you here today because we have a truly fantastic explainer lined up for you. If you're into seeing transparent, real-world options trading paired with some high-level strategic breakdowns, you are in exactly the right place. Today, we're going to unpack a massive weekly win, specifically how we collected some serious premium, and then we're pivoting right into an absolute masterclass on capital efficiency. So get ready, because what we're covering today is literally going to change how you think about deploying your portfolio.
Okay, let's jump right into the raw data. This right here is the actual ledger for our Week 9 option cycle. Look down at that bottom line. That is a beautiful $1,713 in total premium collected for our next week expiring options. We don't just talk theory around here. We look at the real numbers. This lays out the exact positions we deployed to pull that income straight out of the market.
So, here's our game plan for today. We'll start by breaking down exactly how we collected that 1.7K, then we'll introduce the synthetic bull using a super simple classic car analogy, walk through our sector rotation targets, and finally wrap up with some crucial risk management rules.
Section 1. Collecting 1.7K in options premium, breaking down the win. Right, so our income this cycle was heavily, and I mean heavily, weighted toward the put side. Out of 13 total contracts, 9 of them were cash-secured puts. Those puts were basically the engine of this week's profitability, driving a massive 86.3% of our revenue. That translates to $1,479 of pure premium just from agreeing to buy stocks at prices we already liked anyway. The remaining 13.7%, or about $234, came from our 4 covered call contracts.
You know what's really fascinating here? How incredibly concentrated our biggest wins were. Take a look at these top 3 tickers. We sold 2 short puts on Robinhood, bringing in $413. A single short put on ServiceNow netted $257, and another single put on NBS grabbed $253. So those 3 tickers alone contributed over 53% of our entire weekly income. It really just proves that you don't need 100 different positions to generate meaningful cash flow, right? You just need a few really high conviction setups.
Oh, and I've got to quickly highlight this absolutely brilliant piece of mechanics we ran on CRCL. We executed a covered strangle here, basically playing both sides of the market at once. By holding a short put at the $69 strike and a covered call up at $85, we captured a combined $266 across that bracket. It's just a textbook, incredibly efficient way to maximize premium when you're comfortable operating within a defined trading range. But you know, all this premium generation brings up a huge question. Once we have this cash, how do we actually leverage it? I mean, earning 1.7K is fantastic, obviously, but if we want to go out and buy 100 shares of a great stock to capture some big upside, we usually have to tie up thousands of dollars in spot capital. What if there was a way, a highly capital-efficient way, to get that exact same equity exposure without locking up all our hard-earned cash?
Section 2. Enter the synthetic bull. Replicating equity.
Okay, I am so pumped to share this one with you because we are going to demystify a strategy that a lot of retail traders actually avoid simply because the name sounds a bit complicated. A synthetic bull, also known as a synthetic long, is basically an option strategy designed to perfectly mimic owning 100 shares of a stock. But, and here's the kicker, without actually paying the cash to buy them up front. It captures pure equity exposure but completely bypasses the heavy capital drag of buying shares outright.
Section 3. The classic car analogy, understanding the mechanics.
All right, to really wrap our heads around this, let's step completely out of the stock market for a second and bring this down to earth with a relatable example. Imagine you want to buy a rare $100,000 classic car. You firmly believe this car is going to skyrocket in value by next year, but you absolutely don't want to hand over 100 grand in cash today. So instead, you make a legally binding deal with the dealer. Step 1 is your right. That's the long call. The dealer agrees you have the right to buy the car for 100K in exactly 1 year, no matter how high the market price goes. But obviously the dealer isn't stupid. In exchange, step 2 is your obligation, the short put. You promise him that if the car crashes in value, you are legally obligated to buy it for 100K anyway. Because you take on that downside risk, the dealer gives you the upside right for free. And this right here is the absolute magic of the strategy. Just look at the outcomes. If the car soars to $140,000, you exercise your right to buy it at $100K.
instantly pocketing 40 grand in profit. If it stalls and stays at 100K, you break even. And sure, if it crashes to 60K, you're forced to buy it at 100K, taking a $40,000 loss. But notice something. Your profit and loss are the exact same as if you bought the car outright on day one. You just never had to lock up $100,000 in cash the whole time?
So, translating that car analogy directly to the stock market is surprisingly simple. You just execute 2 trades at the exact same time using the exact same strike price and expiration date. You buy an at-the-money call for your upside right, and you sell an at-the-money put for your downside obligation. The beauty is that selling the put collects a premium that perfectly pays for the call you just bought. It's virtually a zero net cost to enter the trade.
Which brings us to a literally game-changing number, 100. By combining that long call and short put, you create what's known as a 100 delta. That simply means your position will gain or lose $1 for every single dollar the underlying stock moves. You are capturing 100% of the upside, but you're only using your account's maintenance margin instead of deploying thousands in spot cash.
Section 4. The sector rotation play, deploying capital.
Okay, so how are we actually deploying the synthetic strategy in the wild right now? Well, our core thesis is that the massive AI tech momentum trade has gotten way too concentrated, and we want to rotate away to play the broadening of the broader market. So we intentionally built a diversified basket using the rule of 3. Our targets? Celsius Holdings, Nike, and Boston Scientific. We chose these because each one plays a very specific, strategic role in our overall portfolio. First up on the roster is CELH, Celsius Holdings. This is our high beta growth spring. The stock has definitely seen some severe multiple compression lately, but get this, the underlying energy drink category share gains and their international runway totally intact. Taking a synthetic position here captures the extreme elasticity of a sentiment reversal. We get all that massive bounce upside without having to lock up heavy outright capital at these volatile, scary lows.
Next up is NKE, Nike. This is our classic turnaround play. It's been trading near multi-year valuation troughs, mostly due to China headwinds and general consumer fatigue. But listen, historically, iconic global brands like Nike form incredible long-term bottoms during periods of deep cyclical pessimism. As the market inevitably rotates back into retail, this synthetic long gives us incredible cyclical upside leverage, starting from a really low base of expectations. And finally, we've got BSX, Boston Scientific. This is the resilient medtech anchor of our basket. Healthcare naturally offers steady procedural growth that is wonderfully insulated from macro consumer swings. Boston Scientific basically acts as our stabilizing force, bringing in non-correlated earnings growth. It ensures our margin synthetic basket isn't overly exposed if pure consumer sentiment takes a sudden nosedive.
Section 5. Managing your downside risk.
Now look, as amazing as capital efficiency is, managing and protecting your downside risk is absolutely paramount if you actually want to survive and thrive long-term in this game. We have to be objective here and acknowledge the catch. Your downside in a synthetic bull is completely unprotected. If you enter this position and the stock somehow drops to zero, you are legally on the hook to purchase 100 shares at your agreed strike price using your account margin. A synthetic long carries the exact same nominal risk as holding 100 shares. You cannot ever forget that.
So to protect ourselves, we rigorously follow 3 golden, absolutely non-negotiable rules of risk management. Number 1, sizing within worst-case assignment limits. Never, ever take on a synthetic if being forced to buy those shares would trigger a margin call for you. Number 2, utilizing a long time horizon. You want to give yourself the flexibility to roll the short put if the stock decides to just chop around and consolidate. And number 3, strict sector diversification across the basket, like how we blended medtech with retail and beverages to prevent a systemic sector drawdown from wiping out your account.
When you truly understand how to utilize your maintenance margin rather than just tying up your cash balance, a whole new world of portfolio construction opens up to you. Earning 100 delta equity returns means getting all the upside of 100 shares while leaving your actual cash fully liquid to generate interest or fund other cash-secured puts. And guys, that is the true, undeniable power of the synthetic long. Thank you all so much for hanging out and learning alongside our amazing community at Noobsellingoptions today. I really hope this explainer gave you some fantastic new tools to add to your trading utility belt. If you found value in this breakdown, please go ahead and hit that like button and subscribe so you never miss our weekly transparent trades and portfolio updates. Keep managing that risk, stay disciplined, and ask yourself this: What stop are you ready to synthetically leverage next? Let me know down in the comments, and I will see you in the next explainer.